Yes, Chair, I can hear you.
All right. A warm welcome to you all this evening. I would like to suggest that we start the main agenda by first considering item 5, which is the paper on climate targets. We can then consider item 4 and 6 together, as these are a training session on investment assets and discussion paper on the fund's strategic assets allocation review. We will then receive an introduction to the fund's strategic assets allocation review from Reddington, our investment consultants. Following this, we will cover the fund's business plan and the actuarial valuation before considering closing with the quarterly update report. Before we begin the main agenda, we can please cover the administrative items, starting with apologies for absence. I've got Councillor Troughton, Councillor Walker, Councillor Chapman, and Ozone for absence. Oh, sorry, Councillor Chapman is joining online, and Councillor Ozone.
Yeah, I'm joining online as well.
All right. Any other apologies? Any other apologies? All right. Agenda item 2, declaration of interest. Member may declare any disclosable pecuniary and non-pecuniary interest in any item coming before the pension committee. Any declaration of interest? Yes, Councillor Radbourne. I didn't
Sorry,
receive.
Chair, we cannot hear it.
Yeah, you have to use your mic.
Yeah, just saying Councillor Gordon can't be here. She's at another meeting, which I should be at, but I'm not actually.
Okay, noted. Declaration of interest. Any declaration of interest?
Yes, I'm a pensioner, Hackney pensioner.
Okay. Any other declaration of interest? No? So we're going to move on. Sorry, I might be moving very fast because I think we have a busy agenda. So I might be moving very fast. Right, agenda item 3, consideration of minutes of the previous meeting. Are there any matters arising from the minutes? Members, any matter arising from the minutes? Online, Jonathan, Henry, any matter arising from the minutes?
I don't know if the Rabia can see, but I've got my hand up. I just wanted to say I'm a pensioner as well. We don't normally share that.
Okay, declaration of interest. Okay, thanks.
Do you require us to do that every meeting now? Because we haven't actually in the past. Hello?
Hello. Sorry, Councillor Chapman. No, I don't believe you are required to declare that every meeting. We'd ask you to put it on the declaration of interest forms, but once that's declared, unless I can't see it being of particular importance to any item on the agenda, so I don't think it needs to be redeclared. I agree.
Thank you. You can't. In my defence, I can't help it. It comes with age.
Agenda item 3. Agenda item 3. Are there any matter arising from the minutes? Consideration of the minutes? No? Can we agree the minutes of the meeting held on 19 January 2022? All right, thank you. Agenda item 5, responsible investment climate target setting. Part exempt, page 49. So are we exempting people now at the moment? Are we exempting the public? Okay. This report proposes a set of 3 new interim climate targets to help the committee monitor progress towards its aim of reaching net zero by 2040. The proposals are recommended to the committee by the Responsible Investment Working Group, who have had opportunity to consider them in detail. Can I invite Jackie to introduce the report before we move on move into the main discussion of the session. Thank you.
Brilliant. Thank you, Chair. So as the Chair set out, this paper is concerned with a really important setting of very ambitious interim targets for the fund to achieve net zero by 2040. The paper is brought forward following a really useful session with the Responsible Investment Working Group, where we went through with Reddington the background to these proposals, and we had indeed had a really good training session, a really good interactive session, and really thank you to all those members of the committee that was able to attend that session. As we've mentioned in the past, what we're moving towards now is setting targets which are not just around the portfolio, but also around real-world decarbonisation. And in line with that, there's 3 targets we're hoping the committee, we're proposing to the committee tonight. The first one concerns reducing the fund's carbon footprint by 50% across its portfolio by 2030. Reddington will explain a bit more about this in their presentation, but just to reiterate, really, this is a really ambitious target which has a much wider scope than the target which the pension fund exceeded previously, but Reddington has set out more about that. The second target is a forward-looking target around implied temperature rise as a forward-looking measure, with 2 degrees for 2030, 1.5 degrees for 2040. And thirdly, we are proposing a climate solution target with the aim of allocating 10% of the fund's assets to climate solutions over the next 5 years. At that point, I'll hand over to Reddington to do their presentation. And I think this item is exempt, isn't it? Am I right, the presentation?
Okay.
So moving on to the presentation for Reddington now, which is an exempt item. Brilliant, thank you.
Yeah. We need to exclude the press and the public. So we're going to say the press and the public be excluded from the proceeding of the committee during consideration of exempt item 5, exempt appendix, and 12 on the agenda, on the ground that it's likely, in view of the nature of the business to be transacted, that were members of the public to be present, there will be a disclosure of the exempt business as defined in paragraph 3 of part 1 of schedule 12A of the Local Government Act 1972 as amended. So we need to wait before we start.
slide 2 that pack. You may remember from a few sessions that we've done with you, our ROSI process. So this training session is very much focusing on the research we've done and your objectives, with the later session on strategic asset allocation, looking to take into account your objectives in setting that strategy going forwards, so that we're looking to optimise what your objectives are. Implementation will very much be the next step, and that will be a later meeting, potentially in June. So then turning to slide 4, and thinking about what is it. Too far? Should have the gloves. Slide 4. Oh, sorry. I do apologise. It's me. I've gone too far. So I do apologise. So what is the fund trying to achieve in terms of your objectives? We've touched on throughout the climate session that your primary objective is actually to pay pensions. And that's your objective as members of this committee. So we're also looking to ensure that the fund has sufficient assets to pay those pensions as they fall due. There's regulations around this. Again, I know we've touched on this before, but I think it doesn't hurt to go over some of this stuff. And the fact that you're looking at the strategic asset allocation to feed into your investment strategy statement, which is part of your regulatory requirement. You do have a responsibility to hold a diversified portfolio of assets, which again we've touched on earlier. So we wouldn't want to be overly concentrated in one asset class. Otherwise, that would increase risk very much in terms of the return, the opportunity to deliver the returns. Sorry, completely lost my train of thought moved on too quickly, so I do apologise. Just moving on to slide 5. So I'm thinking about, again, what is the right level of risk for the fund to adopt, and what's the right level of return? And we're going to come on to those in a bit more detail as we go through the presentation. So, sorry, finally getting to slide 7, which should be the graph. So in terms of why do we need to invest, this graph shows the pension commitments that you have to pay. So over the very long term, you have a growing number of pension commitments as they fall due, and these are your liabilities, if you like. So thinking about what you're going to be able to do to meet those pension liabilities, and as a local government pension fund rather than a teacher's pension fund, for example, where there are no assets, as a local authority fund, you are in the fortunate position of having assets to meet some of those liabilities. So moving on to slide 8. If we think about trying to meet those liabilities, the blue bars are the contributions that get paid into the pension fund from both employers and employees on an ongoing basis. But over a longer term frame, that usually isn't sufficient to be able to meet all of your pension liabilities. So in terms of those additional elements, looking at slide 9, we are looking at the investments that you hold, the assets that you hold, to deliver that gap between the contributions that are being paid in and the ultimate liabilities that you need to pay out. So your investments, you're looking for not only capital growth, but also potentially income to meet that gap. By doing so, you're taking some pressure off some of your employers to cover any gap in the funding, as it were. So what we're looking at on this slide, which is slide 10, without the investments that you hold and getting those returns and making sure you get the income from those investments, you would have this gap, and your employers ultimately.
Sorry, Jill, just for the benefit of the new members, can you just touch a bit briefly on the kind of investment that we have, like, for example, like growth, we invest in growth income or something like that. So for them to just know the kind of investment we do. Thank you.
Yeah, we're coming on to look at more detail in the different types of investments that you hold and the potential range of asset classes that you could invest in. So that's very much in the next part of the presentation. Thank you. So I think probably at this point I'll hand over to Sam.
Thanks, Jill. Evening, everyone. If you can just move to slide 12, please, Rachel. This slide is just looking at where the fund is today and looking at the funding level post the valuations in 2016, 2019, and the more recent valuation in 2022. So there's been a few ups and downs, as you'd expect along the way, given the investment strategy that the fund pursues, but the trajectory is clearly a very positive one, with your assets outperforming your liabilities. So the period post the last valuation in 2019 has been a particularly interesting one. So at the start of 2020, for example, we had the COVID sell-off with markets bottoming out around March time. So you can see that decline in the funding level from 10% from 31 March 2019 to 2020. We then saw risk assets flying in terms of their value over the remainder of 2020 and 2021, which has really served to boost that funding level. And then, of course, in 2022, we've seen the onset of war in Europe. We've seen higher inflation, higher interest rates, and generally assets actually performing quite poorly. So it'll be interesting to see where that position is today. But generally, we think from a funding perspective, we're in a very strong position. At the last valuation, clearly fully funded for the first time, which is very positive news. Moving on to slide 13, there's a couple of very important metrics here in the top left-hand corner of the screen that I think it'd be good to kind of stay aware of as we kind of work through the presentation. So the first one is the funding level. Obviously, I've just spoken about the funding level and mentioned that the fund is fully funded for the first time. So perhaps the most obvious question now is, why not just massively de-risk the portfolio and lock in that position? So to be clear, when we say 106% funded, that doesn't mean that if the fund were to wind up today, for example, you would have £106 of assets for every £100 of member liabilities that you have. What that number is actually saying is, if everything works out exactly as the actuary is predicting into the future, and that includes a very specific assumption around future asset outperformance, then over the life of the fund, you would be 106% funded. So the actual funding level is very sensitive to the outperformance of the assets over time and the assumption that the actuary makes in that regard. Our best estimate, Reddington's best estimate of the future return of the portfolio is the second number down. So that's 6.8% per year, the absolute return. Now, the actuary has their own assumptions. These are typically more prudent than ours, which would be a best estimate assumption. And the actuary's assumptions on future return are what feeds into the discount rate. So it's the number they use to discount the liabilities in the future back to the present value today. And the best way to think about this is that the discount rate is 4.1%, which means that the fund needs to return 4.1% return every year just to stand still. So if you continue to hit 4.1%, you'd remain at 106% funded. So what you're looking to do is actually get a bit of a buffer there and look to generate additional return over and above the discount rate so that you can continue to grow the funding level over time. In terms of risk, there's lots of different ways and metrics that you can look at portfolio risk, and two of those different ways that are shown on the right-hand side of this slide. in terms of stress test and also looking at value at risk or VAR. This is the metric we typically use in our presentation, so you'll see it as we go along. What the VAR is doing is effectively looking to quantify the potential portfolio impacts in a downside negative event. So what it's saying in this instance is in a 1 in 20 worst year outcome in markets, the fund's assets would be expected to fall by at least this number here, 12.8%. So clearly, the lower the better. From the fund's perspective, we're trying to keep that number as low as possible, but at the same time balancing out that return objective that I just mentioned in terms of making sure you're keeping that return high enough that the funding level isn't coming down. From an asset allocation perspective, in the bottom left-hand corner, the fund is invested in a very diversified way. We actually think the portfolio is in great shape. There are some small amendments that we'll make, which we'll come on to, but generally we think the portfolio is in good shape. You're invested across liquid markets, illiquid markets, and across equity, debt, and real assets. And this next section of the presentation kind of drills into a little bit more detail about what those asset classes actually are. So slide 15, so from Hackney's perspective and from an investor perspective, what are the available assets that you can invest in? And again, we've kind of split this out into these broad categories of equity, debt, and real assets. These are your kind of core building blocks of your investable universe. So where are those assets kind of coming from? So you have governments issuing debt for the purposes of raising capital for internal projects, etc. In the UK, that government debt is called gilts, index-linked and fixed interest gilts. And then for the same reasons, i.e. to raise capital, you have companies issuing both debt in illiquid and liquid forms, and also equity in liquid and illiquid forms, depending on the company. And that kind of company capital raising is where the majority of the investable opportunity set lies. Then on the right-hand side, you have real assets. So these are assets that you can physically touch, typically illiquid. So we're talking here really about kind of property and infrastructure. And we'll come on to each in a little bit more detail. Slide 16 just shows, I think it's quite helpful for us to kind of categorize these asset classes by the role that they play in the portfolio. This is the framework we use, and you'll see this as we go through, for example, our quarterly reporting and how we break down the portfolio and how we kind of categorize it into these 4 quadrants in terms of how contractual we think the return is on that individual asset class, and then how liquid or illiquid we think that asset class is. So slide 17, just coming on to equity and fixed income at a very high level. Equity, is typically the asset class that most people will be familiar with. Maybe you have your own kind of stocks and shares portfolio, for example. Equity is effectively buying an ownership stake in a company and then going on to kind of benefit from access to their future profits and growth over time. So LGPS funds have historically had the majority of their assets invested in this asset class in equity on the basis that it is liquid, it is not particularly complex, and it has a high expected return. So previously, when funding levels were much lower and you had quite a high allocation to equity on the basis that it would be expected to outperform the liabilities over time and therefore close that funding gap. Now that's been coming down over the last 10 years, but today the average LGPS allocation to equity would be around 50%. And the downside to an allocation in equity is that it is both high returning, but it is high risk that comes along with that. So fixed income, this is another broad asset class that works in quite a different way to equity. So this is where the fund will loan money to a company or to a government for a fixed period of time agreed at the outset at a fixed level of interest agreed at the outset. So because that level of interest is known in advance, the return stream is much more predictable than what you get in, for example, the equity space. Now, the disadvantage is that, again, because that return is known, there is no effective upside, because regardless of how well, for example, that company is doing that you've invested in, they're paying you, you're locked into that fixed interest rate. So the risk on these type of assets is typically lower, but also the return is lower as well. And these are the two kind of core asset classes that most investors invest across. And the fund, for example, has 85% of its portfolio in fixed income and in equity. Slide 18, what do I really mean when we talk about liquid versus illiquid? So when we say liquid, we mean the ability of an asset to be sold quickly and to be sold inexpensively. So for example, I mentioned that equity was liquid. So any of us, for example, could go onto our phones tomorrow and buy a share in Apple at the click of a button. It can be done very, very quickly, and it can be done at the observable market rates. Illiquid is if you tried to sell your house tomorrow and you wouldn't be able to do it unless you took a huge haircut on the price. It would take you 6 months or so. So liquid assets are typically much more homogeneous. So each Apple share, for example, is the same as any other. Illiquid assets are much more esoteric. So there isn't a house, for example, absolutely identical to yours. And so the pricing takes longer to determine. Historically, LGPS funds have kind of been playing more towards the liquid side of the market, particularly equities, as I mentioned. Over the last 5-10 years, there's been much more of a movement towards illiquid assets. So investing is kind of a competitive pursuit. The LGPS are in a strong position in the sense that they have a competitive advantage by virtue of extremely long investment horizons because of the nature of your liabilities. So you can exploit what we call the illiquidity premium, effectively the additional return that you can generate from having assets locked up for a period of time. So typically we've seen LGPS funds more and more go towards these types of asset classes, which are good liquid asset classes, which are good diversifiers and where you can generate some illiquidity premium. I should also just say that illiquid asset classes can be very different in terms of how they deploy capital. So because the assets are not readily available to purchase, they're not there on an exchange, for example, perhaps they need to be physically constructed in the case of infrastructure, for example, or they need to be discovered over a period of time with a lot of due diligence with private equity, private debt, for example. So there is an initial drawdown period on a lot of these assets that takes a couple of years, where assets are taken that has been committed from the pension scheme is drawn into the fund to then subsequently invest. And then later on, as those assets mature and sold down, those assets are returned to the fund. So it's invested in a fundamentally different way to liquid asset classes. And that's an important point when we talk about cash flow in the next presentation to kind of remember. Slide 19, just a quick one. It's kind of said in investments, there's no free lunch other than diversification. You'll probably know this already, but what you're looking to do is construct a portfolio that is efficient. And by efficient, I mean trying to maximize the amount of return you can get per unit of risk. And you do that by investing in asset classes that behave in a different way to each other. So for example, equities might go up when bonds go down and vice versa. So if you invest across a diversified portfolio of different assets, the overall portfolio is more robust and isn't as sensitive to kind of quite sharp sell-offs in the market. Slide 20 is just what your current portfolio looks like. So you've got around half of the portfolio in equities and equity-like products. You've then got around 20% of your portfolio in illiquid credit or debt. 15% of the portfolio is in other illiquids. So for example, property and infrastructure. And then the remaining kind of 15-20% is in listed corporate debt and government debt. So just digging a little bit deeper into equity, there's lots of different sort of flavors, styles of equity. You can see on slide 21 that the fund has a number of different mandates in this space, and they're all actually doing different things. So you've got quite a lot of options in terms of where you invest. So you have the option, for example, to invest passively, which is where the fund will just replicate a broader index, like for example, the FTSE 100, and just say, we won't make any tactical decisions. We will hold a portfolio of stock exactly like the FTSE 100. Or you can have active managers, which is predominantly what the fund utilizes, which have the discretion to make active buy and sell decisions on the stocks that they're holding, and they're trying to construct a portfolio that will outperform the wider market. There's also going to be differences in terms of where you invest geographically. So, for example, you can have equity allocations in developed markets in the UK, in the US, or emerging markets, for example, and the actual style of the investment itself. So different equity managers will have different styles, different specialisms. For example, they might target stocks with a certain criteria, perhaps higher growth stocks, technology stocks, for example, or maybe they're looking at more established companies, less cyclical, or stocks with a higher expected dividend yield, for example. So generally, when we're talking about diversification, we don't just mean across different asset classes within the portfolio, we're also talking within asset classes themselves. Probably one thing just touching on page 24 is private equity, which is a little bit different. The fund doesn't currently have an allocation to private equity, but effectively just to kind of say what this is at a high level, this is buying ownership in a company. It's in the same way like listed equity, but it's a company that isn't listed on a stock exchange. It's a privately owned company. Often these are smaller companies who are quite early on in their kind of life cycle, so less established. And investing in these type of companies is usually higher risk, and there's more illiquidity because it's difficult to kind of get in and out of those stocks. Just moving on to fixed income, again, kind of like equity, it's a similar story in a lot of ways. You've invested across a number of mandates that all are looking to do slightly different things. There are different flavors here in terms of the different mandates that you can target. So similar to equity, you have the option to invest both actively and passively. You also have the option in terms of where you want to invest from a geographical sense and the style of that investment. So you have different risk profiles of bonds that you can target. You can have different durations, for example. So you can invest in debt over 3 years or 5 years or 10 years, depending on the underlying product itself. So on slide 27, sorry, Rachel, I'm jumping around a little bit, but the main organisations that are really providing this debt finance that's available to invest is governments and corporations. So really the difference between the two is that governments, depending on the government, but usually are seen as lower risk because governments wouldn't want to default on their obligations, whereas corporates, you're going to get a huge spread in terms of the creditworthiness of that company. It could be a very well-established, highly profitable name where you have a high probability of being repaid, in which case that'll be reflected in the return that you get. Or you could go towards the more risky end of the spectrum, companies that aren't so profitable, that might be in slightly more difficult situations, where the likelihood of them defaulting on that obligation is higher, but the return that you'd be paid is also commensurate with that. The key drivers really for kind of the fixed income market are the macroeconomic environment. So, what levels of defaults are we expecting from those underlying entities, and also longer term interest rates, which bonds are sensitive to. And then finally, just on the real asset piece, so looking here at the investments in property with Columbia Threadneedle and the renewable infrastructure assets with the London CIV. On 30, we have the kind of opportunity set in property. Currently, you invest in core property. So this is predominantly commercial property, say office buildings or kind of retail shops, warehouses, for example, generally towards the middle of the kind of opportunity set. One of the options we're looking at a little bit later is around kind of affordable and social housing, which is a kind of similar risk return profile, but does something a little bit different, looking at kind of residential properties rather than just commercial. Core property is really where the majority of LGPS assets sit. And then on slide 31, the infrastructure, again, in the infrastructure universe, similar to property in that you get quite a different spectrum of different risk and return depending on the underlying asset, depending on whether you are physically constructing it at the outset of the relationship, or if you are just buying an asset that is already operational, and what the return stream looks like on those assets. And currently you're in the sort of value add, so reasonably high risk, high return area of infrastructure. And then my final slide before I turn it on to questions is 32. This is just to talking about inflation, obviously that is a pretty hot topic at the moment, given where inflation is. But I think it's natural to be concerned from an LGPS perspective about what that means. Typically, one of the key advantages of real assets, as the name would suggest, is that they have an explicit inflation linkage within their return streams in a way that equity and fixed income don't. And by virtue of that, these types of assets have historically outperformed in environments where inflation is higher than average, as that chart shows. And with that, I will pause for any comments, questions.
Thank you. Thanks for the presentation. Any question? Oh, I've got Henry.
Yeah, that was really helpful. Thank you. I had a question. You haven't mentioned it, but I'm just curious to know where they might fit. We've read a lot about liability-derived investments and their impact somewhere down the line because of rising bank rates. What is an LDI, and where would it fit into this portfolio if we have them? I don't really understand them, so I'm probably being a bit thick, but I would quite like to understand a bit more. So if you could tell me what is it and where would it fit if we had them in this portfolio?
Yeah, absolutely. I think that's a good question that we've certainly been asked before, given the incidents at the back end of last year. So effectively, LDI wouldn't fit into a portfolio like yours. And the reason for that is that LGPS funds have a fundamentally different actuarial methodology than do private sector pension schemes. So the way in which the liabilities are derived for almost all private sector schemes is based on government bonds, based on gilt yields. And for that reason, they are pushed to invest in gilts themselves on the basis that that's the least risk asset relative to their liabilities. And by investing in gilts, therefore, it kind of inoculates the funding level volatility, because it moves, the assets will then move in the same way as your liabilities. So LDI is exactly that. It's liability-driven investment. It is investing in government bonds that are expected to perform in the same way as the scheme liabilities. Now, the trouble comes when you use leverage. So private sector schemes will use derivatives to get effectively additional exposure and additional leverage to those gilt markets. When you're in an environment where long-term interest rates, gilt yields are moving around very quickly, very sharply, that has a huge impact on the underlying value of those assets. And of course, if you're leveraged, it has an even bigger impact. So what we were seeing in the private sector space was that pension schemes had these positions on. The markets were moving so fast, the derivative contracts that they held were effectively getting closed out because they couldn't source the assets quickly enough to send them to their derivative counterparty. And when they lost that exposure, they were then extremely exposed to changing yields because they'd lost the protection of their LDI asset. So effectively, the risk from those mandates comes from the use of leverage. A scheme like this would not use derivatives or a strategy of that type.
Thank you very much.
Thank you. I just want to, I just wonder if you can give us an example of unconstrained active, the type of bonds. You know, you talk about passive active, and we have private credit, unconstrained active. What kind of example can we have for that?
Yeah, absolutely. And actually, one of our recommendations that we'll come on to is actually active unconstrained global credit. So effectively, what we mean by this is that the investment manager themselves have much more flexibility and discretion in terms of where they're investing. So rather than saying you have a mandate which needs to invest in gilts or investment grade credit, you give the manager flexibility to invest across the kind of entire spectrum of credit assets. So they're unconstrained in that sense. So they're able to make kind of relative value decisions on what areas of the credit market are the most efficient and make the best sense given the macroeconomic environment. So they might have allocations to investment grade credit, but they might also have high yielding. They might have emerging market debt. They might have loans, for example. And ultimately, they have more flexibility around the portfolio decisions.
Thank you. Councillor Radbourne?
Yeah, so infrastructure is an extremely broad term, but it's effectively, I mean, it's the building blocks for the economy. So it might be, for example, the construction of toll roads or hospitals or schools, but it could also be airports. It could also be, in the funds case, for example, renewable energy, so wind farms and solar farms. So the reason it's kind of in the same bucket as property is that they're both real assets. So they're both physical assets. They both have a return stream which is quite consistent and is linked to inflation and expected to be reasonably highly correlated. If that makes sense.
Yeah.
Thank you. Any other questions? Yeah, Councillor Deba.
So that is supposed to be annual over time, but that is that's just an indicative chart. So that's not a Hackney specific chart. It's just showing you what the pension scheme kind of broadly looks like over time, and it is annual. Yeah, so looking at slide 20, did you say? Looking at wave. Yeah, so in terms of the impacts of inflation, it's difficult. Inflation has risen extremely quickly over 2022. There are some asset classes that are a good hedge for more volatile changes in inflation. You have some assets, as I mentioned, that have a more explicit inflation linkage. So, for example, property. So they are leasing out certain properties, and the rental increase will be linked to inflation. So, by virtue of that, when the inflation goes up, you're getting additional return on your assets. But generally, your portfolio wouldn't keep pace with this type of inflation. So, for example, if we look at in the credit space, those are nominal bonds, so they are not linked to inflation, so they won't rise with inflation. On the equity side, you could say that there is an implicit inflation linkage in the sense that companies are able to pass costs through to consumers, but it doesn't work exactly in the same way like it would in property, where it's more explicit and you're definitely getting that inflation protection. So long story short, there is inflation protection within the portfolio, but this level of inflation is bad, all else equal, for the portfolio.
Thank you. Any other questions? Anybody? Okay, thank you. So we're going to move on now to, agenda item 6, strategic assets allocation review introduction. This report presents the pensions committee with initial proposal for a review of the fund's strategic assets allocation following the 2022 actuarial evaluation. It introduces a number of proposals for discussion, including recommendations to help the funds achieve its climate targets, meet its cash flow needs, and meet leveling up requirements. Before we move to the main discussion, thank you.
So in the interest of time, I won't say an awful lot before I very probably hand almost straight back to Sam again. So the purpose of this report is we traditionally, following each triennial valuation, it's an opportunity to take, it's an opportunity to take stock of where the fund is. So the valuation reviews the funding strategy. So we consider where the fund is in terms of its funding level, and we consider employer contributions, which, as you've seen from the previous presentation, is one of the levers we have to improve our funding level. And clearly, the second one is that of the investment strategy. So after we've had valuation carried out, it makes sense to, having thought about the contribution strategy, we then also look at the investment strategy to make sure that the two match up with one another, and that we are getting the investment returns that the funding strategy assumes that we are. So traditionally we do a full review every 3 years, and as I think we've mentioned a little bit over the course of these discussions, we can also do a slightly briefer stock take at a more regular interval. So what this paper does is it's setting out a discussion paper around a series of proposals to help address some of the fund's needs, which obviously do change over time. So some of the things that have become particularly clear over the last 3 years is obviously recently we have had and we are about to have a very significant change in the fund's cash flow profile. So we have the LGPS pays CPI linked benefits. So from April this year, our benefit outgoings are going to increase by 10.1%, which obviously is great for our pensioners and a bit of a challenge for us. At the same time, our funding level has also improved, which has allowed the council to reduce its contribution rate, which adds to our cash flow challenge. We've also then in the background, the fund is maturing, so we have fewer active members relative to the number of pensioners we have. And in addition to that, inflation is likely to remain elevated over the near term. So all in all, cash flow is becoming an increasing area of focus for us. It's something that we were prepared for a certain extent, as we'd expected the change in the profile of the fund. We'd expect, in terms of demographics, we'd expected some of those changes around employer contributions. But the very sharp increase in inflation has brought an awful lot of this into focus. So it's something we want to consider as part of our investment strategy. The second aspect that we wanted to think about in detail was the climate targets. Obviously, having set those, we do want to consider how perhaps we might look at meeting those targets, and maybe in particular that allocation to climate solutions target. And then thirdly, we have the levelling up requirements and the expected changes to pooling guidance for the LGPS. So we do want to think a little bit more about how we invest locally and what local means, and also how we can have that sort of levelling up type of impact. And again, try to make sure that we're affecting where we can that real world change. So what Reddington have done for us is they've taken those key considerations, and they've taken the results. They've taken the results of the actuarial valuation, and considered where we are in terms of the risk return profile we're looking for, and some of the factors that you've seen within the ROSI process. And they've basically set out, they've considered a few different combinations of asset classes, and prepared a series of recommendations based on sort of the overall impacts we'd like to see across the fund, and what that means in terms of, say, our expected return, our value at risk, what it means for achieving some of our climate targets, and also what it means for our cash flows. The purpose of today is very much to present this for initial discussion. It's something that, it is as you've pointed out, it's a complex area, and it's something that's new to a number of the committee. So we will be bringing this back again for further consideration, and we'd actually like to set up an additional meeting of the pensions committee specifically to help make decisions around this. So think of today as very much as an introduction. It's being set out for you to consider it and discuss it. It's one of the most important decisions that you make as a committee. So it's really key that we do get the in-depth discussion on this. And without further ado, I'll now hand back over to Sam.
Thank you. Can we exclude the press and public from the proceeding for consideration of the exempt appendix. invite Jackie to introduce the report, please. Thank you.
Thank you, Chair. So the business plan, which is the appendix 1 to the paper, and it's included in the supplementary papers, sets out all the strategic matters for a 3-year period. The plan emphasises the objectives of the fund, including fund and investment objectives. It covers the key risks and sets out the key actions over the coming year. And what it also does is provide the committee members with an overview of what you can expect to see at committee over the coming year, although it is worth noting that the timing and some activities are subject to change as issues can emerge throughout the year and as they have done in the past. Appendix 2 to the paper sets out the budget for the year for the pension fund for 23-24, and I think what you will see in that budget, which is at the table on page 4 of that appendix, is how much the impact of employees' contribution rate affects the budget for the year, and also that what has been mentioned previously today is the rate of inflation, the fact that we're expecting to pay out considerably more to our pensioners in 23-24 than we have in the current year, and it's both those key elements which feeds into the paper on the strategic asset allocation that we've just heard, really. So the recommendation from the report is to approve the business plan, which is actually a slight error in the recommendation in the report, is 23-24 to 25-26, and the budget therein. Happy to take any questions.
Thank you, Jackie. Any questions for Jackie? Councillor Chapman, Henry, Jonathan, any questions?
No.
Right. The pension committee is recommended to approve the budget plan for 2023-24 to 2024-25, including the 2023-24 budget. Can we approve that, please? Yes, I can hear. I can hear you online.
Yes.
Okay.
Yes, from Jonathan.
Yes.
Thank you. Everybody's waking up now. That's good. Thanks. Agenda item is actual evaluation 2022, final evaluation report, funding strategy statement, page 119. This report asks the pension committee to approve the final 2022 valuation report and funding strategy statement. Can I invite Rachel to introduce it, please? Thank you.
Thank you, Chair. So this report is another of the committee, another one of the committee's most important decisions that it takes. So the documents with this report are actually the culmination of around a year's work. So Hyman's Robinson Fund Actuary have been working on this since the end of March 2022. As you'll see from the related decisions section, it is something that's been brought to committee on a number of occasions. So the first item you considered as a committee was some contribution rate modelling carried out by the actuary, which helped to determine the contribution strategy for Hackney Council. So that was carried out in June, and then in September, the actuary brought the whole draft whole fund results and funding strategy statement, and we had quite a long discussion around the assumptions that had gone into the valuation, and essentially how sensitive the funding position was to some of those assumptions. So what this report does is it's actually filling an important statutory responsibility of the committee, which is to sign off on the fund's triennial valuation. So what this is doing is bringing the final valuation report, and very importantly what's known as the rates and adjustments certificate, for your approval, as well as the post-consultation funding strategy statement document. So the valuation report, it's a statutory requirement, we have to have one, and its crucial function is this: it sets out the assumptions that have gone into the valuation, it sets out the process that's being carried out, and it also includes the rates and adjustment certificate, which sets the contribution rate for each of the fund's employers for the next 3 years. And the funding strategy statement is a document. It's targeted essentially at employers And it helps employers to understand the different processes that we've gone through, and also sort of how they are affected by the funds value by the funds valuation. So they're two quite important documents. So what we've done. Sorry, Councillor Chapman, you've asked a question.
Sorry, have you finished? I was just going to ask, is this effectively the point where we formally approve the employer contribution ask?
Yes.
Yeah, I thought so. So it's, yeah, right.
So it was a very short answer, sorry. So what we've...
It answers the question. It answers the question.
So what this paper does is quickly sets out a summary of what's in the valuation and what's in the valuation reports and what's in the funding strategy statement. In section 7, we consider a little bit about the funding level. And first of all, how the actuary has actually modelled everything, and secondly, how they've actually derived the single funding position. So something that the actuaries are always very keen to emphasise, and it's something that I think Sam mentioned earlier, is just how sensitive. The stated funding level can be to the assumptions that go into the valuation, and in particular that discount rate. So just drawing your attention to chart 2, which is on page 119, and it's a chart that you'll have seen when Stephen attended committee in September to talk through the whole fund valuation results. And what it does is it's showing the outcome of the 2019 valuation against that of 2022. And what it's highlighting is that depending on the discount rate you choose, the stated funding position of the fund can really vary quite widely. What Hymans have done in selecting a discount rate is to use a probability. So they carry out a set of what's called stochastic modelling. They model, I think it's 5,000 different scenarios, but please don't quote me on that. And they look at the likelihood that the fund will successfully achieve its aims for any given discount rate. And so what they're trying to show is essentially that the likelihood of success in 2022 for the same discount rate is now higher, as the fund is in a stronger position than it was in 2019. So what they're trying to illustrate is very much that, yes, the single funding position is an important metric for the fund, but it's a snapshot in time, and it is extremely dependent on the assumptions that have gone into the valuation. But it is also a statutory requirement for us to have a stated single funding position. And for 2022, as I think Reddington have mentioned, that funding level is 106% compared to 92% in 2019. That obviously has moved around an awful lot since 31st of March 2022. I think at one stage we hit 150%, but I think it's now back to rather closer to 106. The other key items it picks up on here are the most significant contributors to that increase in funding level. So in that case, it is higher than expected investment returns over the past 3 years. And that's made a material positive contribution to the funding level at 2022. It also highlights how it also impacts how the assumptions that the actuaries use to value the liabilities have changed over that period as well. So the really significant changes here are, first of all, future inflation, which is obviously much higher than anticipated at 2019. And then investment returns, and so future investment returns over the full funding period are now expected to be slightly higher. So that's the single funding position element. We also touch in the report a little bit around the change in employer contribution rates, not just for the council, but also how those are changing for our smaller employers, and how the actuary has worked to set them. And obviously that's different for each employer, as our employers all have different characteristics. So what the actuary's done is to ask a series of questions. So looking at the funding target for each employer. So they're looking at whether the employer is likely to remain in the fund for the foreseeable future. So for example, that's the case for Hackney Council. Or, as is the case for some of our smaller employers, is there a clear exit date? So, for example, where some of our schools might use catering and cleaning companies, the contract end date often gives us a clear exit date for that supplier, and that will influence how the actuary determines their contribution rate. And they also look at the level of risk associated with the employer. So, for example, the London Borough of Hackney, as essentially a tax-raising local council, is considered to be very low risk. The council is considered to be very unlikely to be unable to pay its contributions. And so some of those differences between employers are set out in the funding strategy statement, and it sets out the way the actuary makes different decisions around different groups of employers, or makes different recommendations around different groups of employers, essentially. It also touches on how the employer rate is calculated. So it looks at the primary rate. So each employer has two rates. The primary rate covers it's a rate to cover the accrual of all new pension benefits, whilst the secondary rate covers the cost of funding benefits that have been accrued prior to the valuation date. And both of those rates can change for an employer at evaluation. And it depends on the individual employer as to what the outcome is. But broadly speaking, at this valuation, what's happened is we've seen quite a significant increase in primary rates, that's been largely due to rising inflation. So what's happening is that it is becoming more expensive for employers to fund future benefit payments, simply because those benefits are CPI linked. So obviously, as those benefit payments rise with inflation, employers have to pay more to cover them. But then on the other hand, what we've also seen is, because the funding position of the fund has improved, we've had strong investment performance since the previous valuation, the secondary rate, which covers past benefits, has actually gone down. So the effect on employers has been actually quite variable. And it's been very much dependent on that balance between the primary and the secondary rate. So for the council, for example, which has been paying quite a substantial secondary rate in the past, although its primary rate has gone up, the secondary rate has come down quite considerably, and that's allowed it to reduce its overall contribution payments. So that's what's set out in the valuation report, and in the funding strategy statement. What you're now asked to do as a committee is to approve both of those statutory documents, and you'll be pleased to know that you're being asked to approve them on the second to last day at which this is permissible. So the deadline for sign off is the 31st of March. So these are being brought to you in essentially we always use this March committee at the end of every valuation cycle to request sign off of the final report, and those reports are then submitted by the actuary to government to prove that we've done it. The only other point I need to raise is simply around for anyone who is using a paper pack rather than online, please ignore the valuation report that is in your original pack and refer to the one in the supplementary papers. This was essentially the difference is administrative. I had in error submitted the final draft, which was unsigned by the actuary. So to make sure that we're signing off on the correct report, please do make sure that you refer to the signed version in the supplementary pack. But I'd be happy to take any questions otherwise.
Thank you. Any questions, members? Henry?
Yeah, Nate, just 2 points, one of complaint and one of question. One, I just say that these are two really important papers. I slightly object to getting them after two and 3/4 hours of meeting. It's a bit steep, but because they are really, really important papers, I can just sort of make that point. I'm but in terms of just asking a question, just declaring my interest as chair of the 4 Mossbourne schools. I'm just trying to understand what these figures are telling me. If I go to page 34 of the Hymans-Robertson report and go to line 3, you can see Mossbourne Community Academy. I'm just trying to understand what this is telling me. We got a primary rate of pay of 24.6. We then get a discount of 5.3 for the secondary rate. And is this telling me then, if you add the two together, obviously one's taken off the other, that the rate for Mossbourne Community Academy will be 19.3% for the next 3 years? Is that what we're being asked to agree? I'm just trying to understand it.
Yes, it is.
Okay.
What the rates adjustment certificate sets out is it's showing you in the first column the primary rate.
Yes.
It then gives some employers will pay a different secondary rate in each of the 3 years covered by this valuation, which is why there are 3 columns for secondary rate. So everybody pays the same primary rate. Well, they pay their own primary rate consistently across the period because that does not change for each employer.
Okay.
The secondary rate can change, so it's shown separately for each year. You then see, because that secondary rate can be different for each employer, you then see the final 3 columns show the total contributions for each year. So for Mossbourne, because your secondary rate is the same every year, you pay the same overall rate in each of the 3 years covered by the period.
Okay. So if I go down the page to Caterlink, that's now got a 22.6% primary rate, then a secondary rate of minus 22.6%, and therefore nothing to come. They pulled out of the scheme, have they? Is that the right conclusion?
So without wishing to pick on Caterlink specifically, where an employer is paying a nil rate, it will very often be to do with the management of surplus if they have a clear exit date.
I see. Okay. So
we are now required to pay exit credits to employers.
Yeah.
We're working with the actuary on ways to manage this for our smaller employers, but for some of them where they have already built up a substantial surplus.
So that's why. Okay. No, that's why. I'm not complaining. I'm just trying to understand it. Okay.
No, it's a reasonable question. I can't, without sort of specific reference to Caterlink's case, that is often why that would occur.
Okay. All right. Thank you.
Just to address your point around the funding strategy statement, and I ought to have clarified. Apologies for its late submission. So what I ought to have noted in the report, and will note here, is that the funding strategy statement has been brought before the committee previously. So it was approved in September for consultation with employers. It's now come back to the committee unchanged. So we've had no changes as a result of the consultation. So this report is as you saw it when it was presented in September. Apologies for not flagging that was the
No,
case.
that's helpful. Thank you.
Fine, thank you. Any more questions? Right. So the pensions committee is recommended to approve the 2022 valuation report, approve the post-consultation funding strategy statement. Can we approve it? Online, do you approve it?
Yes.
All right, so move on to agenda item 9. Pension Fund Quarterly Update Report, page 165. This report is an update on key quarterly performance measures, including an update on the funding position, investment performance, responsible investment, administration performance, and reporting of breaches. This quarter, I don't know, something that T includes a new investment performance report from Reddington, who will also provide a short economic summary. Can I invite Richard to introduce the report, please? Thank you.
Thank you, Chair. So in the interest of time, can I suggest that we take most of this report as read, unless there are any specific questions. One item that I would like to highlight, though, is that the report includes a new investment performance report from Reddington, who will also provide a short economic summary. So what I'd suggest is that we listen to the brief economic summary, and then take any questions on either that and the rest of the report if there are any. Is that okay?
Yes, Jill, do you have any addition to that before any questions?
No, that sounds great from our perspective. So we'll jump straight into the market update slides, which is 189, 190 in the combined pack. So it's the way in which, conscious this is the first time that Reddington have done this, but the way in which we like to provide our quarterly updates is, as Rachel says, I'll kind of provide a little bit of an update on what's going on in markets, what the key drivers are over that quarter and since the end of the quarter, because often these are a little bit out of date by the time we actually get to speak. And then that will hopefully give some context to how your managers have actually performed, and if there's anything pertinent, Jill will bring that out in the manager report itself. So I'll do a streamlined version of the slides that are in the pack. So Rachel might be jumping between slides a little bit, but I'll keep it relatively brief, just talk about the narrative that's really been driving markets over 2022 and early 2023, and then a little touch on the banking shenanigans that have happened since. So on slide 3, which is slide 191 in the combined pack, we'll begin. So the narrative that's really been driving investment markets over the past year or so, year and a half, has been inflation. So we've seen inflation spiking to extremely high levels, double digits inflation across the developed markets, inflation at a level we haven't seen since the early 1980s. Most of this has been driven by the increase in food pricing, energy pricing as a result of the invasion by Russia of Ukraine, as well as a bit of a hangover from a supply side perspective of the supply chains of China and their response to the COVID outbreak. So the key question is, what are central banks doing to combat that inflation? And really, there's kind of like two weapons in their arsenal. So the first on page 4 is around how accommodative their stance is towards either quantitative easing or quantitative tightening. So we've been in a phase post the financial crisis, and particularly as well post-COVID, of a quantitative easing phase. What that effectively means is that central banks have been printing money and pumping it into the economy via purchases of bonds. So what that does, it puts credit into the economy, it gives banks more money to lend, and it's there as a stimulative measure. So they're trying to grow the economy by pumping this money in. What do we see over 2022? Well, in order to try and combat the inflation, what they did is move to a tighter policy where instead of pumping liquidity into the markets, they're actually taking it away. The other kind of weapon they have in the arsenal on page 5 is around interest rates. So we've seen consecutive interest rate rises across the UK, US, Eurozone on this slide. It's not just the number of interest rate rises, but it is the speed at which those interest rate rises are going through. And post this document, there's been a few more in the UK and in the US, for example, and then the impact that kind of has on markets. So on slide 6, we just illustrate just how quickly markets are moving, and you can see this is the fastest tightening cycle, i.e. interest rates by central banks are being moved higher, faster than has happened at any point in history. So this is going to have fundamental impacts on underlying asset classes, particularly those that are linked explicitly to interest rates, like bonds. So slide 7 just shows the impact this has had on government bonds. So this is long-term interest rates, effectively. Now, long-term interest rates, government bond yields have been falling pretty consistently for about 40 years. And 2022 was the year where that really reversed. We've kind of been seeing those yields rise across the year as expectations of future interest rates feeds through. And what we circled there is in particular, is the volatility in the UK market around the mini budget at the back end of last year. Now, what that's resulted in on slide 8 is strong negative performance across credit assets over 2022. So we've seen both kind of credit and government bonds both selling off, both kind of double-digit sell-offs across the entirety of the bond market. One of the worst years in history in the bond market. On equity markets, on slide 10, it was a similar story. Most markets we've seen falling in value and quite sharply. Actually, for the first time in a very long time, the UK outperformed. And the reason for that is on slide 11. If you look at these sectors and how the underlying different equity sectors performed over 2022, all of them down with the exception of energy. So when the invasion of Ukraine happened, as I mentioned, energy prices shot up, policy prices shot up, and unsurprisingly, energy companies did very well off the back of that. The UK stock market is quite biased or has quite a strong exposure to financials and to energy companies. So no surprise that the UK actually had a reasonably positive year in 2022, and other markets really struggled. One interesting trend we saw on slide 12, particularly post-COVID, was the dominance of these so-called kind of mega caps, the likes of Apple, of kind of Tesla, of Alphabet, really outperforming these tech names, and in a big way. And what we saw over 2022 was the complete reversal of that. So technology stocks generally are quite sensitive to interest rates, because the way in which their future cash flows are discounted are based on interest rates. And so they're hit harder if interest rates rise. And actually we saw was quite a strong reversal of fortunes for those types of company. I shall move straight on to some of the more recent developments on slides 16 and 17. Really, there's kind of been two different narratives in the market over 2023. The pictures, for those that wouldn't understand it, is a bull and a bear. Bull effectively means that people think that the market's going to go up. Bear means that they think the market's going to come down. So what we saw at the first, early on in the year, if we move on to slide 18, is that we saw these inflationary pressures start to ease off and start to come down. So the market's saying, we think that inflation has actually peaked across the developed markets and it's now coming down. And that's really been driven on slide page 19 by falling energy costs and also loosening labour markets. And we're likely to see this kind of phenomenon continue as we move forward into the year. So that has meant that central banks can take a slightly different tone in terms of how they're approaching the problem. Because if they see inflation coming down, that means that they don't have to be so aggressive in terms of raising interest rates and their monetary policy. And so they won't have to kind of suck this demand out of the economy, and the likelihood is then that they can try and avoid a recession in the global economies. So initially that was the narrative, and we had a very strong start to the year. However, in March, if we move to slide 23, clearly the narrative moved away from inflation and interest rates, although of course that feeds into this, and thinking about the banking sector. So this slide just puts into context the the size and the scale of Silicon Valley Bank. Silicon Valley Bank was not a name that we probably would have been familiar, certainly a name that I wasn't familiar with, but it was a very large bank. I think it was the 16th largest bank in the US. And actually its failure was the second largest bank failure in history, only behind Washington Mutual in 2008. Now, if we move on to slide 24, the concern is really what impact that will have across the wider market. Is SVB the canary in the coal mine that's going to trigger a number of other collapses in the same way that Washington Mutual and the likes of Bear Stearns, etc., did in the back end of 2007 and 2008, which then prompted this kind of wave of defaults across the banking sector. Now, there are a few reasons why, on slide 25, we see, or markets generally see SVB, Silicon Valley Bank, as a bit of a special case. Two key reasons. The first one is their deposit base. So who was actually investing money with Silicon Valley Bank? What you can see is that Silicon Valley Bank were actually, the investors in SVB were a lot of early stage technology companies, venture capital type funds, and quite early stage companies. Now, one of the phenomena in kind of banking recently, I mean, if you think back to 2008 Northern Rock bank runs, you think of people standing in the street waiting to get their cash. Not anymore. You know, this deposit base is made up of people who are on social media, who are reading the news, who are ready to withdraw their funds at a moment's notice. Also, 90% of the deposit base was uninsured. So in the US, that means their deposits were over $250,000. And if there's a failure at the bank, the government won't insure those losses. So if you have those assets in that bank, and you've heard rumors that that bank is going to fail, the first thing you do is going to pick up your phone, click of a button, you're going to move your deposits to somewhere else. So that was the first issue. They had a very vulnerable deposit base. And the second issue on slide 26 was their unusual vulnerability to rising interest rates. So banks generally invest across a number of longer duration and interest rate sensitive assets, like government bonds, like mortgage-backed securities, and SVB were taking a particularly large risk. This is slide 26, Rachel, and effectively carrying that on their balance sheet. So with banks, they tend to, for example, if they're holding a government bond, it's due to be paid back, let's say in 3 years' time by the US government. They know that's effectively, there is no effective credit risk with that bond. So they can hold that on their balance sheet and have an unrealized loss. So if you're going to get paid back in full in 3 years, you're fine. Now, the issue is if the market value cuts that level of bond in half and it's now worth $50 instead of $100, and all of your depositors have pulled their money, that moves from an unrealized loss to a realized loss, because you have to sell the bond at $50 and able to pay your depositors. And Silicon Valley Bank were particularly vulnerable to the level of interest rate rises and the sharpness of those rises that we discussed earlier on in this part of the presentation. So they were particularly at risk. European banks generally are in a stronger position than US. The regulation's a little bit tighter, and their capital ratios are generally a little bit higher. So on slide 27, this is why it was a little bit of a surprise, particularly for some market commentators, when the issues in the States moved over to Europe and we started hearing the news that Credit Suisse could potentially be the next bank to go. Obviously, Credit Suisse being a household name, being a historically important bank. Ironically, one of the only kind of larger banks with an investment banking arm during the financial crisis that needed absolutely no support from the government was seen to be in a strong position, but a litany of kind of mismanagement since then kind of put them at risk. And obviously, post us drafting this paper, they were bailed out by a combination of UBS and the Swiss Central Bank. I'll move straight on to slide 30, just to kind of one of the key points. This is a famous Warren Buffett quote that only when the tide goes out do you discover who's been swimming naked. So effectively, companies have been able to benefit for years from very, very low interest rates, so very low borrowing costs and borrowing money at low rates. Now That's all gone up, that's all changed, and it's much more costly to issue debt, for example. It's much more difficult to issue capital, and that is causing a big strain on the economy and on companies. And so the likelihood is that we're going to see further defaults from here. Final slide on me, I'll jump straight forward to slide 36, if that's all right, Rachel. Just to go on to the so what, why do you care? Effectively, we're in a new environment now. We've got much higher inflation, we've got higher interest rates, and we think there's going to be slower growth, and that's clearly presents some headwinds for investors. We would say, don't panic. You know, the fund has a very long time horizon. You're in a very good shape, and you've made a lot of progress in terms of diversifying away from your kind of more traditional drivers of return, like equity, for example. The recent data, you know, particularly looking at news on inflation and growth, does mean that the markets are quite sensitive to what the Fed does and what the UK central bank does. And so that does mean that there's likely to be a bumpy ride ahead, particularly in equity markets. Again, you have active managers, they have discretion to make portfolio decisions. They have the ability to try and avoid areas that they think there is particular risk in, and areas that they think maybe are over leveraged, or companies that they don't think have great growth potentials going forward. So again, you're diversified, and the managers that you've invested in have the discretion to trade appropriately. And then the final comment around high yields, there's a flip side to this. Now that the yields are higher, actually this is a much better entry point into things like multi-asset credit, which was one of the suggestions as part of the SAA review, where a year ago, maybe in multi-asset credit was yielding 3%, whereas today you can get 6-7%. And that's obviously, you know, a very attractive yield, and really feeds in as well to the income distribution that those sort of mandates can pay out. So that's all I was planning to cover on that, and happy to take any questions.
Thank you. Thank you for your presentation. Any questions? Councillor Chapman?
Thank you. It's a really helpful and interesting report. Just multi-asset credit and the good returns you were just referring to there, in the light of what we've just been looking at in terms of our asset allocation. I mean, the general understanding, isn't it, that higher returns come with higher risks. Are there any warnings there?
Yeah, absolutely a fair question. We think there are. So you're right. So historically speaking, when there's been spikes in yields like this, so thinking financial crisis, COVID, for examples, a couple more recent examples, what you see is yields spike up. Defaults do tend to rise, but not at the same level. So it's not commensurate. In other words, you're getting overly compensated for the additional level of risk. And that's ultimately the question you're asking yourself. Yes, risk might have increased slightly, but are we being compensated for that risk? And we would say that you are in an area like multi-asset credit. Plus, those managers, again, have the ability to flexibly allocate between sub-credit asset classes. So if they're thinking, you know, high yield debt, there's risk there at the moment, they can shift into better quality names, for example.
Thank you. Any further questions? No? Pensions Committees is recommended to know this report. Can we know the report, please? Thank you. Agenda item 10, AOB, I've not been notified of any urgent business. So agenda item 11, can we exclude the press and public from the proceedings for consideration of the minute of last exempt minutes of the previous meeting? Yeah, is it done? Yeah. Right. Right. And we agree the exempt minutes of